Hey everyone, welcome back to Corporate Decoder, the place where we crack open the most complex corporate documents to expose the juicy details you won't find anywhere else. And let me tell you, this latest filing from Inventrust Properties Corp is a treasure trove of information, especially when it comes to their financial health and future plans. So imagine a massive report like a financial yearbook for the company. That is basically what this is. It's their annual report and it gives us the full picture of how they did in 2025. Get ready because we're diving deep into their numbers, their strategies, and those little risks that could pop up. Let's jump right into the heart of it. Inventrust is all about owning and managing shopping centers, especially in those sunny Sunday Belt states. As of the end of 2025, they own 73 of these properties, covering over 11.5 million square feet. That is a lot of retail space. And get this, they had an economic occupancy rate of 95.4%. Meaning most of their shops were actually being paid for by tenants. That is a pretty solid number, showing they're doing a good job keeping those spaces filled. Now, where are these shopping centers? Texas is a big one for them, making up a huge chunk of their income. Austin, Houston, Dallas, San Antonio. All big players, Florida and North Carolina are also key markets. This focus on Sunday Belt states is a deliberate strategy. They believe these areas are growing faster in terms of people, jobs, and money, which means more customers for the stores in their malls. Who are the big tenants renting out all this space? Well, it's the usual suspects you'd expect in a shopping center. Kroger, Publix, TJX companies like TJ Maxx and HomeGoods, and Amazon's Whole Foods are all major players in their tenant list. It is good to see a mix of essential stores like grocery stores, which tend to do well even when the economy is a bit shaky. This next part is super important for understanding the company's future income. It's all about when their leases are up for renewal. Looking at 2026, about 5% of their space is set to expire, and that jumps to over 14% in 2027. That's a significant amount of leases coming up around the same time. While they had a pretty good renewal rate on leases they managed to sign in 2025, this upcoming expirations period will be a real test. Let's talk about the money. Their total income from leases was nearly $300 million in 2025, a nice jump from about $274 million in 2024. This increase is thanks to new properties they bought and also better performance from their existing shopping centers. But costs are also going up, depreciation and amortization, which is basically accounting for the wear and tear on their buildings, shot up to over $128 million. A big chunk of that is due to the properties they acquired. Speaking of acquisitions, they were quite busy in 2025, buying 10 new shopping centers for a hefty $464 million. They also managed to sell off some properties, bringing in over $306 million. This constant buying and selling of properties is part of their strategy to focus on those booming Sunday Belt markets and ditch properties that don't fit their plan anymore. Now, let's look at net operating income, or NOI. This is a key metric for real estate companies, basically showing the profit from their properties before accounting for things like corporate expenses or interest on debt. Their NOI was over $206 million in 2025, up from around $186 million in 2024. That's a healthy 10% increase. And a big part of that comes from their same properties, the ones they owned in both years and could directly compare. Same property NOI went up almost $8.6 million, or about 5.3%. This means the existing properties are performing better. Taking all the numbers together, net income for 2025 was a very strong $111 million. That is a huge jump from just $13.6 million in 2024. The main reason for this massive increase in profit is the gain on sale of investment properties. In 2025, they sold a portfolio of California properties for a gain of almost $91 million. When you divest properties for a big profit, it really boosts your net income for that year. To understand their true operating performance, we also look at something called funds from operations, or FFO. This is a special measure for REITs, and Inventrust even calculates a core FFO. In 2025, their NAREIT FFO was about $147 million, and their core FFO was around $143 million. Both are up from 2024, which is a good sign that their core business operations are improving, not just relying on property sales. Now, let's talk about debt. Companies use debt to grow, and Inventrust is no different. They have a $500 million revolving credit facility, which is like a flexible loan they can draw on, and a $400 million term loan. In August 2025, they actually extended the maturity dates on their term loan, which gives them more breathing room. Their total debt at the end of 2025 was just over $825 million. While they have a lot of debt, it is important to see how it compares to their assets. Their assets, mainly their properties, are valued at nearly $2.8 billion, so they own a lot more than they owe. Interest rates are a big deal too. Inventrust uses interest rate swaps to lock in fixed rates on some of its debt. As of December 2025, they had several of these swaps in place, helping them manage the risk of interest rates going up. For example, on a 5.5-year term loan, they've effectively secured a fixed rate of 4.84%. Which is pretty good in a rising rate environment. Looking at their debt maturities, a good chunk of their mortgages are set to mature in the next few years, with over $61 million due in 2029 and another $21 million in mortgages maturing in 2028. They plan to use property sales and cash on hand to handle these, which is a common strategy. Now, every company filing has this section about forward-looking statements. It is basically them saying, hey, we're talking about the future here, and things could change, so don't sue us if it doesn't happen exactly as we say. They list a bunch of risks, like tenants not paying rent, economic downturns, and even natural disasters. One big risk they highlight is people shopping online more, which definitely impacts physical stores. They also mention the risk of economic shifts in their concentrated markets, like Texas. It is good they're aware of these, but it is also a reminder that owning real estate always comes with uncertainties. So, what is my take on Inventrust Properties Corp? After looking at this filing on the surface, they seem like a well-managed company with a clear strategy. Their focus on Sunday Belt retail and grocery, anchored centers is smart, as these types of properties tend to be more resilient. The significant increase in net income for 2025 is impressive, largely driven by strategic property sales that boosted their bottom line. Their FFO numbers are also moving in the right direction, showing their core operations are healthy. They've also done a good job managing their debt by extending loan maturities and using interest rate swaps to get predictable borrowing costs. However, there are always things to watch out for. Those upcoming lease expirations in 2026 and 2026 and 27 are a point of attention. While they have a good renewal track record, a lot of leases coming due at once can put pressure on rental rates if market conditions aren't favourable. Also, the increasing costs for things like depreciation and property operations are something to monitor. The company is growing, which is good, but growth always comes with rising expenses, overall. Inventrust appears to be navigating the retail real estate landscape effectively, capitalizing on strong markets and diversifying its portfolio through acquisitions and strategic dispositions. The key will be how well they manage those lease renewals and continued economic shifts. What is your take on Inventrust's latest report? Do these numbers give you confidence in their direction, or are there red flags you are seeing? Drop your thoughts in the comments below. If you found this breakdown valuable, please hit that like button. It really helps the channel out, and be sure to subscribe for more dives into the world of corporate finance. And don't forget to join our Discord community linked in the description for more discussions and insights. Thanks for watching, and I'll see you in the next video.